Hi everyone, in this video we'll be looking at Greggs. So Greggs is a UK listed company selling sausage rolls, bakes, sort of sweet treats, sandwiches and such. So in this video we're going to go through the fundamentals of it, look at the company, have a look at some valuation metrics and see what we're looking to pay for it. So let's start with the latest Q3 trading update. So as of day of recording this, it's the 5th of October, so just the day after this has been released. So what we're seeing generally around the market is that companies are sort of struggling to keep up the growth from last year. They've had the rising costs and it is affecting profitability. So let's have a look at how Greggs is doing at the end of 2022. So sales are up 14.6% for the 13-week period. Like-for-like sales are up 9.7%. So they've added more shops, added more sort of avenues to market there, so delivery and such like that. They're opening, expected to open 150 net new shops in 2022. They've had 90 net new shops year to date, 106 openings, 16 closures. I think with the closures, although we'd like to see that they don't waste their money on closing stores, at least it shows that they're sort of aiming for the profitability and sort of continued growth within the closures, and rather than just sort of keeping shops going that aren't beneficial to the business. So what we're seeing here is they've recently had new pizza production capacity commissioned this September. So what they're trying to do as a sort of business is open up more into the evening, get more of the afternoon trade. I believe they say about 8% of uh, of their market is currently daytime, with a larger sort of growth avenue for the company opening later in the day, catching people coming back from work, catching people going out for drinks and such in towns. So part of that is adding more food that's acceptable later on in the evening, albeit pizza, hot food, and such like that. So that's what we're seeing here on their sort of new production line. So they're adding more capacity. Full year outcome expected to be in line with our previous expectations, so we'll go to that in a second. So we can see here, as expected, year growth moderated in August, given particularly strong staycation effect in 2021. So even given the strong year last year, they've still seen 14.6% growth in sales. And they also shut for the day for the Queen's funeral. So that was a day in lost sales, which would have improved their results by about 1 percentage point. As we can see here, they talk about their new menu items, which are all relatively simple food, but it continues to drive sort of growth into that evening trade. We can see here that they are also planning to reduce the amount of capex this year and just move it into next year. So it was previously mentioned about 170 million, which can be seen here, and it is now due to be about 120 million. So we'll see about 50 million less increase in free cash flow, but that will just be moved into next year. So what they're seeing in costs. So the cost inflation here is around 9% over like for like to last year. They have actually raised their prices sort of in line with that this last year, so that's sort of helping sort of cover their margins over this period. So let's move on to the sort of business stats now. Let's see how they're doing, see what sort of profitable margins they have, what sort of return on capital they have. So let's go over to ROIC.ai, which is an excellent website, and I'll just get onto that. So before we get into this, I'd just like to ask if you're still watching at this point, please can you like and subscribe? Trying to get to the goal of 1,000 subscribers by the end of the year, which is a bit ambitious, but let's try and go for it. So let's have a look at Greggs here. So this is the value line numbers. What Warren Buffett always sort of quoted as sort of the best baseline figures for when comparing a business. So we can see here at the top, PE, if you consider that, it's 16.3. Forward PE is a bit dodgy, just given that it's a UK company. So this software is not really built for UK, so it doesn't have a lot of the analysis of Greggs. PE to S&P 500, 0.9, market cap, which we worry about, 1.9 billion. Dividend yield, 3%, again, just slightly off because it's a UK company, so it is actually 3%. So let's look here. So revenue per share, we can see here that is slowly increasing over time. So we've had 4.42 all the way up now 12.12 over a 14-year period. Earnings per share has been increasing as well, which is good to see given their common shares outstanding has not been increasing. It's been staying steady. So they do offer options, but then they buy back shares every year to sort of counteract those options. CapEx, we can see, is relatively low. They've currently increasing their CapEx now to so they're currently increasing their CapEx to allow for the increase in their production facilities, so they can churn out more food, churn out the pizzas, as we mentioned earlier, the hot food, and allow for greater expansion to their target of 3,000 shops. We can see here the operating margin has increased, so 8% in 2010, 12.5% last year, 0.9% negative, given the drop in the COVID year, obviously being a sort of primarily a in-store retail company. All the shops are shut, so then they decided their sort of delivery option last year, sort of ramped it up majorly. The return on invested capital, we can see, has been pretty steady. So the effect, obviously, last year, again, they didn't have any profits given a lot of the stores were shut. We'll see this last year, 2021, 18.1% return on invested capital, which is pretty good. It's a it's a solid return. They seem to post consistently sort of high, mid to late teens. It's quite a simple business in that respect. So once you have the production capacity, you supply your own shops, then there's not too much additional capital required for the sales once you have your production facilities. So over here on Simply Wall Street, we can see the business stats for the company. One thing I'd like to point out is the gross margin, 62.84. So they've got a healthy gross margin. They can absorb some initial inflationary costs on their raw ingredients. So say they have a sausage roll that sells for £1, it costs them 38p to make that. So there's a bit of wiggle room there on the pricing power of their goods. We can see here the growth has been pretty consistent over the last 5 years. We can see last year, obviously, they had a reduction in profit due to a lot of their stores closing. However, this is reflected well in their cash generation over the years. So obviously last year they had negative cash generation given a lot of the stores are shut. Since then, they've actually made their business more resilient as they sort of have a great reliance on delivery and sort of quick service on the go food. So let's look at the financial health. So we saw there on the previous slide that the cash flow was negative in 2020. We can see that they previously had no debt, building up their cash, 85 million in cash. And then obviously COVID hit, they increased their debt to 150 million, and then they've reduced it down within a year back to zero debt. So they have a very, very, very strong balance sheet. And we can see they've been building their cash position, which will be likely dropping over this next year as they invest in their new facility in Newcastle. They pay a progressive dividend, so we can see the history here. So the sort of teal single line is the dividend per share. So over the time, it has increased, not drastically, but it still has increased. And we can see they stopped paying it in the sort of COVID period, and then they've continued paying it now. So it's currently about 2.9% yield, and they will likely carry on paying a progressive dividend as the company profits grow. So let's now go on to the DCF, or discounted cash flow analysis, to see what we should be paying for Greggs. So I've got their projected growth rates from years 1 to 5 at 7%, 6 to 10 at 5%. I've gone for the discount rate at 10%, given that is more than the UK gilts currently, even with the government's messing up of the interest rates, and with the US bonds as well. The terminal value I've got as 20, so I believe that Greggs will be around for a long time. I believe with their strong balance sheet, their simple menu, their sort of traditional, you could say sort of British food, I believe it's sort of around to stay. They're seeing consistent growth, even though the sort of high street is in decline. They're going to more drive-throughs. They're going more where people are on the go, which are identifying as their sort of key growth drivers. And the move into evening food, I believe, will fit them very well as a sort of low-cost Mackey's alternative in the UK. So their current year one free cash flow is 120 million, so that's represented here in 0.12, which all these numbers are in billions here. Excess cash is at 0.15, so 150 million. Current market cap is 1.91 billion, which gives it a per share value of £18.73. So given my forecasted growth rates, I believe, like I said, that they've got a continued sort of path to increase their revenue, more shops, evening trade, increased delivery products. I believe they can continue growing around the same pace and then taper off in sort of later years. So given that, I've sort of estimated a rough intrinsic value of around £18, sorry, £25 per share. Obviously, that is within a wide range, some big assumptions here. But it sort of gives a flavour of where the company could be if these forecasts come true. Um, I believe, given their balance sheet, given their sort of high return on invested capital, Greggs is definitely a company worth researching further. So if you've got any other companies that you'd like me to look at or any suggestions on my videos, please let me know in the comments. Thank you, and please subscribe and like if you can. Thank you very much.